watching from Smyrna, Tennessee, Pittsburgh, Staten Island. Wow, you guys are really clicking in. Cleveland, Ohio, Wilmington, Delaware, Bossier City, New Orleans, we see you watching. Metro Detroit, Jackson, Mississippi, New York City in the house, Bloomington, Illinois. Thank you all so much for watching. All right, let's get started for today. Again, we do ask that if you are just clicking in, if you would just put in the chat box where you're watching from and the organization that you are affiliated with. This webinar is being recorded, so if there is any portion that you just so happen to miss, you can log on to our YouTube channel, which is National Housing Resource Center, and watch any of our webinars. This PowerPoint presentation will be added to the chat box. If you want to follow along with the PowerPoint presentation, you can click on it. It'll be in the chat box. Closed captioning has been enabled for this webinar. If you need to use this feature, just toggle your mouse down at the bottom of your screen and click the CC button, and the closed captioning will show up. There will be a portion at the end of this webinar after everyone has done their presentations where you can ask any questions that you have for any of our presenters. So if you have a question, we do ask that you add it to the Q&A box and not the chat box. Our chat box is constantly scrolling and we don't want to miss any of your questions. So please, if you remember, put your questions in the Q&A box and not the chat box. We do ask that if you follow us on all of our social media channels. We're on Twitter, Facebook, Instagram, and of course our YouTube channel, where you can find all of our Leaders in Housing Counseling webinars that we have posted, not just this one, but ones from previous years. And then also you can follow us, check out our website where you can also view our webinars there. We have a blog. You can join in NHRC from our website. You can sign up to receive further emails in regards to our Leaders in Housing Counseling webinars. So please go to our website. We have loads of information on there that would be helpful. Excuse me, as I mentioned, please join NHRC. If you are not a member and not taking advantage of the benefits of being an NHRC member, you may want to start signing up today. Consider signing up today. There is a tremendous discount that we have for our CoreLogic tri-merged credit reports. You'll be hearing more about that later on in this presentation. So if it sparks your interest, you want to join NHRC to take part in this benefit, go to our website and get started joining us today. Oh, okay. So we're going to move this portion over to Bruce and he will take it over from here. There you go, Bruce.
Well, thanks so much, Ebony, and thanks everybody for being here. We're going to be really fast because we've got a lot we're going to do on today's call. We'll do some quick updates, but make them super fast so that we can get to the main topic at hand, the latest on credit reporting and credit scores. You're going to see that we've got lots of the major providers here going to give us, I think, very interesting and helpful information. Please feel free to ask questions and make this as interactive as you can using the Q&A box. So I'm going to move us quickly through here. I expect that we will go well over the hour and maybe even a little bit over the hour and a half, depending on how many questions we've got. We do really want to try to serve you well on these. And of course, as always, this will be recorded and you can come back and listen to it if you miss any part. So great. With that, welcome everybody. And let's dive in. I'm going to start us off. So our national conference is going to be March 27th and 28th. It's Monday and Tuesday. It's right before the NCRC conference. So if you're going to that, we wanted to save you some money so that you could do it a full week. And it's also in DC. We're at the AFL-CIO National Headquarters. It's a very cool, very interesting building. But the really best, interesting, and cool part is going to be that you're going to be with lots of the leading thinkers around housing counseling and some of our cutting edge issues. And if you come, you'll be a chance to meet lots of your peers from all across the country. These have been just terrific meetings. If anybody's been to an HRC conference in the past, we call them the Leaders at Housing Counseling Conferences. You know, they're pretty dynamic and they do move the dial forward. And we want you to participate in that. We've already got big commitments from HUD to be there. And we are talking with others about innovative opportunities here that will help you advance your work, and we hope collectively advance housing counseling. So registration is not quite open yet. We're working on the technology of that. Should hopefully be this coming week. Ebony's hard at work on that. And so as soon as it gets in, and there'll be a discount for early bird registrations and discount for people if you're going to the NCRC conference as well. We really do want to support our friends in all this. So with that quick note, I'm going to move it on. And I think Christy's going to talk to us next about what's happening in Congress.
Hi, everyone. Thank you so much, Bruce, for that update. And thank you all for joining us. So first, on committee assignments, the House and Senate have released some committee assignments for key housing committees, such as the Housing or the House Committee on Financial Services and the House Committee on Appropriations, but they have yet to finalize the full list of members. However, we do know that Representative Patrick McHenry will become the chair of House Financial Services, and Representative Maxine Waters will be the ranking member on this committee. So also, Representative Tom Cole will be the chair of the THUD subcommittee on the PROPS, and Representative Mike Quigley will be the ranking member of this committee. And on a PROPS, I did want to mention that we did meet with Representative Tom Cole of Oklahoma, and it went really well overall. It was our first meeting with his office, and they seemed really responsive towards supporting HUD's Housing Counseling Assistance Program. So that's great news. In a few months, I would say that programmatic request letters will be submitted to various offices. It would be really helpful to have housing counseling agencies engaged at the local level. Overall, it means a lot more when constituents are involved in these programmatic requests because it shows that there's ample support for a funding increase for this program. So if you'd like to be involved, please stay tuned. I will likely reach out to some of you about this. And yeah, that is all on my end. Well, I do want to mention that as far as FY 2024, it is a little too early to discuss some funding levels because members are still being assigned. But there is likely to be a continuing resolution from what we've heard on this funding level cycle. And so, yeah, we'll keep you updated, and I'll pass it on to Eric.
Thank you, Christy. Sorry I'm offline. Sorry I'm off camera. My computer isn't acting right today. I'm here to discuss the job board that we have. As of now, we have about 44 jobs posted. These jobs are located across the country, and they all require you to be a HUD certified housing counselor. That's all I have today. I'll pass it over to Ellie. Thank you.
Thanks, Eric. And with that, I am going to get us right into our presentation today. As Bruce mentioned, we have a lot of information. We may go over the 90-minute scheduled time period, mainly to get your questions answered. I do want to make it clear that the panelists are not in order of importance in any way. Every single one of the panelists today has a lot of really great information to share with you. So if you are not able to stay on for all of the panelists, you absolutely need to go to the recording afterwards so that you can hear what everybody has to say. And with that, I'm going to go ahead and hand it right over to Kelly Cochran, who is the Deputy Director with FinReg Lab, for her to begin her presentation. Kelly, take it away.
Great, thank you. Thank you so much for the invitation to speak today. I'm really looking forward to the discussion. I'll start by just explaining who FinReg Lab is for people who don't know. We're a nonprofit research organization about 5 years old. We're focused on the use of data and technology in financial services with a particular eye towards financial inclusion. So a lot of our work is focused on credit reporting, scoring, underwriting issues. And I am not going to talk through every element of my slides today. They're more for reference, but at the end, there's a list of some of, and links to some of our publications in case that's helpful. So maybe we can move to the next slide. In general, there's been a long-standing interest in continuing to improve upon the traditional credit reporting data and scoring techniques to improve the system of underwriting for inclusion, for accuracy, for all these concerns. There's various concerns, and I think the events of the last couple of years have accentuated some of them. One is just kind of timeliness and comprehensiveness, since the reports generally have traditionally focused on past payment history on particular credit report products, and they're reported on a lagged basis, which means in a time like the pandemic where economic conditions are changing rapidly, it may take time for reports to catch up. There have been concerns about gaps in accuracy, particularly with regard to about 20% of US adults who can't be scored under the most widely used models today because they just don't have enough history in their traditional credit reports. And finally, concerns that continuing to rely on kind of the historical data and scoring models could either replicate or exacerbate past discrimination, lack of geographic access to banks, targeting by high-risk lenders, and other factors that create racial disparities kind of in the system. If we move to the next slide, what we're seeing now as people are coming out of the pandemic and the triage has settled down a little bit is an explosion of policy pilots, programs, new initiatives to really make progress on some of these questions, continue to expand and improve upon data and techniques. I'm going to talk through some of those innovations very briefly as a kind of overview and scene setter before we get on to the other speakers. It's really exciting to see these develop, and we're still learning about how they can potentially affect and expand inclusion in the financial system and for homeownership in particular. At the same time, there are concerns that come along with changing the system. And so I'll also briefly summarize a few of those that cut through many of these initiatives. If we move on to the next slide, we'll talk just a bit about cash flow data. This is an area where FinReg Lab started some research several years ago to look at the potential benefits, largely of using bank account information to get a more complete picture of consumers' finances, rather than just focusing on how they paid past credit. Gives a sense of inflows, outflows, cushions, and kind of how they manage their finances on an ongoing basis, right up to the day that the data is pulled. Since we've released our studies on this and the federal regulators issued a statement in 2019 recognizing that cash flow data in particular had real potential for increasing inclusion, we've seen a number of additional expansion or new initiatives coming out. Most recently in the homeownership space in particular, Freddie Mac and Fannie Mae both announced in late 2022 that they are using the systems that they've built to help pull bank account data for things like income verification to also allow consideration of cash flow information. The scope of the programs vary. They're still being implemented. Fannie Mae's, for instance, is limited to consumers who don't have credit scores, while Freddie's looks to be a little broader. So we'll be learning a lot from those programs as they go forward, but it's potentially helping draw in this information in a quicker process to help expand home ownership. If we turn to the next slide, there's a somewhat overlapping group of initiatives, some of which do also rely on bank account data and some other sources that are focusing specifically on capturing more information about consumers' utility, telecom, and rental payment history to supplement things like credit payment history. So this is coming from a number of different areas, and I know there was a webinar on this just a couple months ago, so I won't spend a ton of time on this slide, but one thing I did want to point out recently is that Equifax announced that it will now start providing telecom and utility payments history along with, but separate from, traditional credit reports when they're pulled for mortgage purposes. So that potentially could be another source of information that lenders could then use It's being limited so that it can only be used to help consumers as they go through the application process rather than to reject them. But we're seeing just a broad range of initiatives in this space. Many of them are customer permissioned in the sense that it requires the consumer to authorize their data to transfer. And that's also true with the bank account data that we talked about on the last slide. So that's a very important change from the traditional system where furnishers push information into the credit bureaus and it goes on to the lenders. The consumers are not necessarily a part of the gating process there. If we turn to the next slide, we're also seeing a few spaces where there are developments that are causing new debates about credit reporting, credit scoring, and how additional information flows may come in. One is the growth of buy now, pay later initiatives. These are often structured where a consumer checks out, for instance, an online retail transaction, and they're offered an opportunity to pay in 4 installments without any additional cost as long as they pay on time. This kind of data generally is not flowing into the traditional credit reporting system today. And there's been a lot of interest in changing that for 2 reasons. One is the potential inclusion benefits of documenting that consumers are paying on time. The other is concerns that this could turn into a substantial source of debt for consumers. And if it's not getting captured in traditional reports, lenders might not understand that that's kind of outstanding. So in 2022, we saw a lot of activity on this with the credit bureaus and the CFPB kind of discussing how to get this information in the system. There's questions about whether it will flow into main reports or remain separate, but a lot of interest in this area, and it'll be interesting to see where that goes right now. In the meantime, I think there is some possible confusion among consumers about whether it is going into their reports and how it's affecting things. So it's an important area to watch and educate as we go along. If we turn to the next slide, another area of kind of similar emerging, evolving situation is the diversification of credit builder products. Credit builder products have been offered for years in the form of secured credit cards and credit builder loans that are often offered by traditional lenders or credit unions as a way to help consumers build a credit record. The proceeds are usually escrowed and then consumer pays and gets them on time. So it's almost more of a forced savings mechanism than a true loan, but it is often reported to the credit bureaus much like an installment loan, and it could be a potential way for a consumer to build a credit record in the first instance. We're seeing a lot of new product structures develop, particularly in fintechs that are offering different types of credit builder programs. As these diversify, there's a couple of questions that are coming up. One is about the fact how they get kind of reported into the system and how traditional scoring models assess these products. They might be telling us a lot about consumers wanting to build better credit, but they don't necessarily operate the same way that a traditional one does. So the signal might be different, and how do we account for that in the system? Other questions are just, do the consumers understand all these different product structures that are cropping up, which ones are likely to help them? And there's some research that suggests that some of these credit builder products may be more helpful for consumers who don't have a credit record than for consumers who are trying to repair a credit record where they've had past history of delinquency. So a lot of things evolving in the space, and also an area to watch. The final innovation that I wanted to mention, if we move to the next slide, is not on the data side, but more on the technique side. And that's the use of machine learning techniques to analyze either traditional data or some of these new sources. This has potential because machine learning techniques can really discover kind of more nuanced relationships than traditional models often do. But there's also concerns about them because the models can be more complex and kind of less easy to understand. And so that raises questions about monitoring, management, making sure that they're not having disparate impacts and other things like that. So this is another area where we're doing a lot of research, understanding kind of how to manage and diagnose these models. And so that's another space to keep an eye on as we go forward. There are already a number of cases where machine learning techniques may be used to identify particular attributes that could be used in scoring models or underwriting models, but the whole model itself that's used by the lender may be a more traditional model to kind of help manage some of these concerns about complexities. So as we look at all of this, if we turn to the next slide, there's a lot of potential here, but there's a lot of learning that still is coming. These are a lot of pilot programs, a lot of new initiatives. There's much we don't know yet. And so as we look at that and look at how consumers navigate the space as all of these things are going on, there are a couple of themes that kind of weave through in terms of potential concerns and policy areas of focus. One is the concerns about protections for customer permission data flows. As I kind of mentioned at the beginning, a lot of these new data flows involve the consumer saying, yes, I want my data to flow from one entity onto the lender that is evaluating my application. And so that raises questions because the traditional credit reporting system doesn't rely as heavily on customer permission. And so there are questions about how do kind of traditional accuracy, privacy, and other protections apply in the space. Where is it similar? Where is it different? Where do we need to adjust, either because of the difference with customer permission or just because of data concerns as they continue to evolve? So the CFPB has a rulemaking underway right now that could potentially address a number of these topics, although we don't know yet exactly what scope it's going to cover. So there may be more rounds to go, but that's a particular important area of interest to everyone, and also potentially affects consumers' willingness to permission their data to flow, to know that it's protected. A second concern here is risk of bias and just more generally unintended consequences as people are working with new data and getting a better understanding of what signal is there and how to build it into additional existing systems. We know the process of developing new scoring or underwriting models takes a lot of data, and it takes a lot of time to kind of analyze, to vet, and then to potentially implement, especially when it's a kind of general scoring model that might be used by many individual lenders. So everyone's kind of thinking through that question. A lot of research going on, trying to analyze, and also questions about, as we're in this learning phase, how do we manage those concerns as we go along? A lot of the pilots that we're seeing right now are restricting in various ways. So maybe they say that data can only be used in a positive fashion. For instance, to move a consumer who would otherwise be rejected from a no to a yes, but it can't be used to move a consumer from a yes to a no. Or other ways of kind of really limiting the pool of consumers and data being considered. That can be helpful as kind of a stepping stone to kind of build our knowledge and understanding, but there are also potential trade-offs if you define something really narrowly. So for instance, it only affects consumers who have no score at all. It doesn't necessarily help consumers who have scores, but might also benefit from use of the data. So, there's a lot of thought going into those kind of questions right now. And then the final question is just kind of about public understanding, research, and consumer confusion, and understanding in particular. There's so many different products and initiatives going on, and for them to understand which ones are likely to help in their particular circumstances and, kind of just navigate the system is another area of interest, and obviously a place where housing counselors can be a really important resource. So I'll stop there and hand it off to the next speaker. Thanks again.
Thanks so much, Kelly. That's a lot of really great information. We're going to move right along now to CoreLogic Credco, and we're going to start with Tammy Foster with CoreLogic. So Tammy, go ahead and take it away.
Hey everyone, I'm Tammy. I work with CoreLogic Credco. And so we do a lot of partnering with NHRC in regards to providing their members with credit report access. We provide 3 bureau credit reports merged. And so Ken and I are here to spotlight the Credit Expert suite of products, which is one of my favorites because it really does help people understand what they need to do to accomplish their goals to get an increase in the score if that's what they're looking for. So with that being said, I'm going to pass it over to Ken so that he can go over the product specifics as well as do a quick demo.
I do apologize for that. So CoreLogic partners with the folks at Credit Expert, who is a third party that developed SCORE tools to help formulate a strategy or a game plan for a potential lift to the consumer score. And on our credit reports, the cover page that is delivered will provide a preview if there's an opportunity at each of the bureaus for that potential lift to take place. So this allows the targeting of efforts, reduce the guesswork and the consequences of guessing incorrectly. Again, as consumers are making an attempt to get more informed on credit and scores, there's just so much information in the marketplace. It can be so overwhelming, can be so confusing. And so the folks at Credit Expert developed these tools to assist in targeting the efforts. The hyperlinks that are embedded in this particular report called Credit Assure will launch our website at credco.com. It will bring users into our site so they can select one of the two products that are available, the Credit Expert Wayfinder and the Credit Expert What If Simulator. Credit Expert Wayfinder will create a score plan based upon a range here of score bands to eventually move into. So if I were to select a random score band here, in the background, Credit Expert is devising a strategy or a plan to move the consumer from that starting point into the next band. The yellow button for the See Details will provide the detailed explanation as far as which accounts that need to be addressed and the specific course of action to be taken to achieve that potential lift. And what's also helpful in the gray shaded area are some suggestions and recommendations of things not to do, right? So we don't want to take a course of action that would counter what the results that have been provided by Wayfinder. So it provides some helpful guidance. Conversely, the other product that's available from Credit Expert is called the What If Simulator. And it's answering the question, what if I take a particular course of action? What would be the results? It's providing basically an estimate. So with this particular bureau, when I click place order, each of the credit grantors records here will appear, as well as the other items within the report. And you can simulate a specific course of action. So perhaps maybe there is an account that should no longer be reflected within the consumer's credit profile. You can simulate the removal of that account, and the system will provide in a matter of seconds an estimate as far as the potential impact from that course of action. There's also a link that will allow the simulation of adding an account. So perhaps there is a consumer that would benefit from adding a particular type of account. So you can select from the drop-down menu the type, enter additional details, and there's a calculation that will estimate the potential impact from adding an account. And then finally, two incremental timeframes that will estimate with payments made on time, over time, the potential lift that could be experienced by the consumer. And again, these are just estimates, but it provides a nice starting point, a nice foundation, again, working through some of the challenges with the information overload that takes place. So Ellie, again, my apologies for the audio issues, but with that, completing the overview of the Credit Expert suite, I will pass along to our next speaker.
Great, thanks so much, Ken. I want to just take a moment to remind everybody to please put your questions in the Q&A box, because otherwise we're going to lose track of them. And you always have such wonderful questions. I don't want to miss anybody's. So please put your questions into the Q&A box. Even if you've already put them in the chat, please enter them into the Q&A box as well. And with that, we are going to move on to our next presenter, Elaine Cozart, who is the client engagement consultant with FICO. So Elaine, take it away.
Thank you so much, Ellie. And thank you everyone for taking the time to attend this webinar today. I love, hearing all of the other speakers and all of the cool things that they are doing to really help consumers get educated about credit reporting, credit scores, managing their finances, and things like that. I know that's certainly something I wish I had had in my younger years. So my role here as a client engagement consultant is to really help facilitate that credit education, specifically regarding FICO scores. And I manage the program specifically for credit and financial counselors, the FICO Score Open Access Program for credit and financial counseling. So let's take a look at what this program is all about, and what's included and how you can become a part of this. So first of all, what is FICO Score Open Access for credit and financial counseling? First and foremost, it is a free program. So just keep in mind, it is a free program for credit and financial counselors who are already pulling FICO scores with the credit report. Our program license agreement is the only license that gives you permission to actually share the FICO score with the consumer. So if you're pulling FICO scores, we want to get you into this free program so that you can stay in compliance and be able to share those scores. But beyond that, it is a credit education program. So we're helping you to educate your clients on not only their FICO score and how to manage to it, but really all the things that lead up to that, right? Helping make sure that they're paying their bills on time and all of those good things, good credit behaviors. We'll go ahead and move on to the next slide. And what is included in this free program? So we have a website that hosts all of these materials, but I just want you to realize the website is more like a library. So it's not yet another system that you have to log into every day and do your work from. So library of materials that include reference materials to help you and the rest of your counselors stay updated and educated yourselves on the FICO score program, the model, and things like that. Guides to help you get started. I'm also a resource to help you get started and proceed with the program. There's a very extensive Q&A document. And then kind of the gem of the program is the summary report generator tool. And that is basically a simple document that allows you to create a really nice handout very simply for your clients. If you go to the next slide, I believe we have a picture of that. So many of you are probably already seeing your own personal FICO score through your bank, your credit union, your credit card company, your mortgage lender, your auto lender. They are all a part of the lender version of the FICO Score Open Access program. They're pulling lots and lots of scores every month or every quarter. And so they have the technology behind the scenes to be able to automatically share those scores. For credit and financial counselors, you are sharing, you're pulling a score one at a time, you're sharing it one-on-one with the consumer. So we've created a very simple Excel workbook where on the left, you can see that it has the inputs from the credit report. So remember, the FICO score is a model that scores the data in the credit report. So when you get that credit report with your FICO score, you're going to fill in the input tab, and then you'll have several options for handouts, specifically English and Spanish versions. But then on the right-hand side, you have a really nice document to give to your client. So it includes the FICO score, where that score came from, because the date of the pull, the version of the FICO score, and the credit bureau, if any one of those three factors is different from what they're seeing in their bank, online banking, all of those other sources, that will be an explanation for why their FICO score could be different from what they might be seeing from one of their lenders or banks or credit unions. The next thing on this that is really the true education specific to the client, and this really goes, is a nice companion, goes hand in hand with what Ken was talking about with, I'm looking up the name of the product, the Wayfinder. these top two items, the key factors affecting the FICO score, these are directly the reason codes that come off of the credit report. And so these are the top two items on the credit report that are pulling down their score. And then there's additional information about FICO scores, but lots and lots of counselors tell me that they love this tool because it gives them some place to start on the credit report review. All right, so that is kind of your main tool, but let's take a look at the next slide and I'll show you some examples of some of the other resources that are available to you. The first is the basic facts about FICO scores. You can kind of see a picture of it. It's kind of diagonal in the lower right-hand corner. Really wonderful, consumer-friendly document about FICO scores. It's 4 pages and provides really a lot of great education, not only about FICO scores, but those things that consumers really need to keep in mind when managing their credit to be able to appear less risky to lenders. That is the key to the FICO score, right? It's a measure of risk to a lender. Next is we have a really great video series. We have counselors or counseling organizations that actually put these on their websites, and you can use them in credit education or homebuyer classes. The FAQ, excuse me, that I mentioned earlier, it's available in English and Spanish, and really answers every question you might have about FICO scores. We also have the FICOscore.com website where this is a public facing website. Anyone can access this. You don't have to be part of the FICO Score Open Access program to access them. Both of those sections, the education page and the info page, have lots of great consumer information. We also have created a slide deck for those of you that are putting on homebuyer classes or other types of credit education classes. And it's, just a few slides about FICO scores to help educate your attendees in that program. All right, so the next slide, so these materials are kind of what I think of as static. And then we also really try to keep you updated on a quarterly basis with a newsletter. On a quarterly basis, I also host a webinar called Demystifying FICO Scores, which takes a deeper dive into what goes into the score. I show a sample scorecard so you can see how data is scored or categorized in the scoring model. And for those of you who are not currently part of the FICO Score Open Access program, you've got plenty of time to enroll before the next presentation, which will be on February 22nd. So I hope that you're able to join that. All right, moving on. Let's talk about what it takes to be eligible to participate in this program. So first of all, to get started, there are 2 documents that you'll want to fill out. And the first one is an application questionnaire. And basically in that first document, you are going to attest that you or your organization fits each of these 4 items. So first of all, there is at least one counselor or coach in the organization who has a primary focus of providing financial counseling. I realize that lots of organizations, nonprofits out there are doing great work in a variety of different areas within a community, and credit and financial counseling may only be a portion. But if you're offering credit and financial counseling, you are eligible, or at least in that particular first item. Second would be that you would have an active end user agreement with one of the bureaus or Credco, their reseller. And then next, to be a 501c3 nonprofit or a government agency that provides social services. And finally, the last qualifier is that you not be considered a credit repair organization as defined by CROA. On the next slide is just kind of a preview of the process to get started. So determine eligibility, that's the last slide that we just looked at. The second document that we have is a program license agreement that you would read and sign and send that back to me along with the application questionnaire. We will turn that around and get a counter signature to you. And then from there, I send you a welcome packet so that you can get access to the library of materials. And then the fourth box there is to inform staff and other counselors. And I can also be a resource for you as well. I typically will host about a 45-minute meeting to go over all of not only the materials, but the best practices for when and how and where to use each of the materials. And then you are off and running. And this is typically a pretty quick process. There are some exceptions, and I can always let you know when I see your application, but the URL that you see at the bottom is where you can go to download the materials, or I believe Ellie is going to be sharing all of our contact information. You can always email me directly to request the forms, and I will email them to you. That is all I have for today. If you have any questions about this free program, please be sure to put them in the Q&A and we will cover them at the end. And now I will hand it off to the next presenter. Thank you so much, Ellie.
Thanks, Elaine. I'm going to ask you one quick question because it came in a few times. Do you have to be part of FICO Open Access to attend that webinar on demystifying credit?
Yes. Yes.
Okay. Simple answer.
Yes.
Okay.
Thank you for asking.
All right. Thanks. So we're going to move right on to our next presenter, which is Rod Griffin. And Rod is the Senior Director of Consumer Education and Advocacy at Experian. Rod, take it away.
Hey, thank you so much. And thank you for being everybody. I appreciate the opportunity to talk to you about our Experian Boost and Experian Go programs, which I think fit well into what the other presenters have discussed as well. Next slide, please. When about 4 years ago, we started looking at how do we help people who traditionally don't have access to the credit reporting system gain access to that system, because we know that there are about 28 million credit invisible consumers, people who simply have no credit history. We know that Black and Hispanic communities of color are adversely affected and overrepresented in the credit invisible community. We know that there are young people who turn 18 every year, perhaps have never had credit. Grandson who just had a conversation with about how he can build credit. So kind of affecting my family as well. And the issue isn't that the people who are credit invisible don't manage money well. It's simply that they've had no way to connect with the traditional financial system. And that's what we started to study and try to understand, how do we empower people to do that? Next slide, please. So about 4 years ago now, we launched Experian Boost. It was the first of its kind and still remains, I think, the first consumer permission tool that allows people, enables people to have positive, non-traditional credit reporting information reported to the credit history. So a person can now, by enrolling in Experian Boost, have their positive cell phone payments, positive utility payments, positive streaming services, and now have their positive rent payments reported to Experian's credit history to help demonstrate that they perhaps are better credit risk than a very limited credit history would show. So the key word there is positive. We only report positive information. It's a free service. It's permission-based. So the individual gives us permission to access the payments that they want to include and specify what those are. And if they choose to stop, they can tell us to stop, and we will remove the information from the credit history. It takes about 15 minutes to enroll. Very simple to do. We can even help identify accounts that might qualify as they go through the process that they perhaps aren't considering. The Key thing is to understand how that information comes to the file. The consumer gives us permission to access the account they pay those bills with each month, whether it's a checking account, a savings account, credit card. And we are then able to capture that payment each month, just as if it were a payment for a traditional installment loan or a credit card payment. And we incorporate that information in the credit report as an account. So a person could, when they enroll in Boost, add a cell phone payment, a utility payment, and a streaming service like Netflix. I sometimes jokingly say that who knew that date night watching a movie on Netflix could also help your credit scores today. But you can have those added to your credit history. We will incorporate them, update the payments each month, and will help demonstrate that a person is engaging in positive payment behavior that traditionally wouldn't appear in a report, because those organizations, utilities, streaming services, cell phone companies, telecoms don't traditionally report positive information to the credit bureaus. This enables us to capture both sides and make sure that the person is getting credit where credit's due effectively. What we're finding is that for people with thin credit files, scores on a FICO 8 score of 680 or below tend to see the most improvement. On average, about 13 points with thin files, actually as much as 19 points on average. So a meaningful improvement. We also made sure that before we launched the product, there wouldn't be an adverse impact on scores in a way that would give a false impression of the person's history. So we ensured that there is no false positive, if you will, or increase in scores that wasn't warranted. What we see is, and what our research has shown, is that if a person is just starting out, building their history, doesn't have a lot of negative information, just has very little history, or has been moving in the right direction, scores will tend to improve. If they've had late payments, bankruptcy, lots of issues recently, Boost isn't going to suddenly give them a huge jump in score. It's not going to work that way. So it's a very predictive element in scoring. And so it's critical because, again, it shows that positive information. Another thing that we ensured was that the information, when it's added to the credit report, does have a positive impact on scores. We give the consumer a FICO 8 score at the beginning of the process of enrollment, and then a score at the end so they can see what's changed. There are older models that we have found react adversely to the data, not because there's an issue with the data, but rather because the model doesn't incorporate it appropriately. In those instances, we simply don't feed the Boost information into the scoring model. So we ensure that it doesn't have a negative effect where it should not. And so that's a critical component to understand. But what we're finding and getting feedback from consumers is that Experian Boost is an incredibly powerful tool to get them to the starting line. It's not the tool that's going to get you across the finish line. It's not intended for a person who is almost qualifying, just needs 5 more points. If I enroll in Boost, I'll qualify and get that loan I want. That's not the goal. The goal is really to help people who have not had access gain access, begin to build credit over time, so that when they're ready to buy that house, ready to buy that car, that their credit history is built and grown to a point through new accounts and other tools to qualify. And so Boost is a tool to help people get started. Next slide, please. The other factor is that in order to have Experian Boost applied to your credit history, you have to have a credit history. So if you have no credit report, we can't add the information because we have no report to add it to. To that end, last year we introduced something called Experian Go. It's a tool that enables a person who has no credit history whatsoever to enroll in a free service. And if they don't have a credit history with Experian, we'll walk through a process to create that credit report for them. So when they come into our system, we will ask them some questions about identifying information, have them take a live selfie so we can see who they are, provide a photo of documentation of their identity, some other things, and we will create a credit file. It will be empty. So it would be identifying information only. The benefit to that, though, is now if they have a cell phone payment, if they have utility payments, they can enroll in Experian Boost And that data can then be added to the credit report and then help them begin that journey of building their credit score. Next slide, please. It's really simple. As I said, you just go to our app on the phone. It's meant to be mobile based because that's where we see most of the people who benefit accessing technology. Provide the information they need or we need, and we'll create that credit history or that credit file, and you're off to the races, essentially. Next slide, please. And I'll turn it over to the next speaker. So not a lot there to talk about. It's a consumer-based program, all free, all permission-based, and I hope to answer any questions you have. Thank you.
Great, thanks so much, Rob. And we are now going to move on to Melinda Opperman with credit.org. And I just want to say here, thank you so much to Melinda, because as a board member for NHRC, she really worked with me and helped me kind of figure out who should be part of this webinar. So thank you to Melinda. So take it away.
Thank you, Ellie. I'm Melinda Opperman with Springboard Nonprofit Consumer Credit Management. Most of you know our DBA is credit.org. I'm the Chief External Affairs Officer with credit.org, and our organization is a HUD-approved housing counseling agency, an intermediary, so to speak, and a nationwide consumer credit counseling agency, and we're proud to be members of NHRC, and I'm proud to serve on the board. So thank you, Ellie, Bruce, and team for the opportunity to speak about this important topic from the perspective of a HUD-approved housing counseling agency. Ebony, my opening slide there indicates that data wins grants, and grants help fund our work in this space. So on the next slide, we have here how credit health is critical for a better future and building generational wealth. And so what we have found is that data effectively helps frame basically our ask to our funders and our grant applications. So on this slide, I have a table, and it's data from a recent study of millennial renters. And the chart is broken out by race and ethnicity. And on the chart, the two bars that are on the left side indicate that 60% of Black millennial renters and 44% of Hispanic millennial renters viewed bad credit as the largest obstacle to homeownership. So the study helped to kind of sculpt our convincing needs statement for the grant we were working on and the important work that we do as a HUD-approved housing counseling agency and as a credit counseling agency. So next slide, please, Ebony. So tracking client progression. So we can track specific actions taken by our clients via the use of the FICO Open Access, the Experian Boost, the Credit Expert, Wayfinder, all the things that the panelists discussed. These tools have been a game changer for us at credit.org. For example, we're using the FICO Open Access, the Credit Logic tools. They kind of create, as the panelists indicated, their own like handouts and little mini action plans for our clients. This is in addition to our own specific client action plans. Those of us that are housers, you know, we call those client action plans our CAPs. So these little mini handouts they provide, they're in addition to the CAP that we provide. So for example, in that Experian Boost tool that was discussed, where we have had where our clients have been underbanked or unbanked, we have been able to encourage them, look, we need to start having you use your deposit only bank account or become banked, your subscriptions, your utilities. We're going to be able to have those tracked if you're having these reoccurring utility payments, etc., handled through your bank deposit account versus, you know, you're having been paying them by money order, etc. So this has really improved and bumped up our clients' FICO scores. And then on that final slide where I'm indicating how we can report outcomes to our grant funders. So we were faced with the need to be able to report some specific actions, specific results. And so with these tools, we've been able to do that. So the data kind of brings the outcomes to life in a meaningful and powerful way to our funders. Next presenter, please.
Great, thanks, Melinda. So we're gonna wrap up the presentation with Bruce McCleary, Senior VP Membership and Communications at National Foundation for Credit Counseling. Take it away.
Thank you. All right, thank you. Hello, everybody. I'm Bruce McCleary with the National Foundation for Credit Counseling, nfcc.org. And just real quickly before I begin, it's really nice to be here along with a number of our member agencies in the audience, including Melinda Opperman's credit.org, and of course, everybody else in the broader housing and credit counseling sector. Let's skip ahead a little bit and let's go to the next slide. So today I'm going to be, actually, if we could go back just a second, sorry. So today we're going to be talking about a couple of topics that relate to credit counseling and debt management plans and their impact, the outcomes, and how those affect consumers who are enrolled and how that affects their financial future. And just as a little bit of a preview, and many of you are already familiar with credit counseling and debt management plans, but you know very well that they often go hand in hand with the housing counseling experience, helping people prepare for home ownership, assisting prospective home buyers, and assisting those who might be struggling to preserve home ownership and getting them in a position where they can avoid foreclosure and find a way to affordably remain housed. So of course, the mechanics of the debt management planning are pretty simple. Many of our nonprofit agencies that are a part of the NFCC network offer them as a result of a credit counseling session to assist people who are struggling with affordable credit card debt and getting them positioned to affordably pay off their debt with interest rate reductions, fee adjustments, and account re-aging in helping people complete those programs in as little as 4 years and sometimes even less. The long-term positive impact of credit counseling and debt management programs, it's detailed in the research that's been conducted by The Ohio State University as part of our Sharpen Your Financial Focus program. You can find that information on our website at nfcc.org. And if you scroll to the bottom and click on Client Impact, there's more there. But despite the many benefits that are detailed in the research and that many of you know firsthand, there remain some opportunities to further improve outcomes and enhance credit reporting related to accounts enrolled in debt management plans, as well as accounts enrolled in settlement programs. So if we can go to the next slide, we'll start by tackling the issue of debt management plan credit reporting and utilization. And so we can advance to the next slide and we can look at the issue, the challenge, and some of the opportunities that are ahead of us. And these are things that are priorities for the NFCC in helping, again, enhance the consumer experience and improve outcomes for consumers who are enrolled in these programs. So payments on debt management plans, as many of you know, they do have a special credit reporting code to flag the type of payments, but use of the code is not required and it's not consistently followed. For example, some creditors don't use the code when reporting payments. So what we're hoping for and what we're looking to accomplish is to develop a more consistent utilization of the code in order to provide better data to the industry. And payments flagged as part of a debt management plan could help demonstrate consumer goodwill in repaying outstanding debts, even when facing hardship. And therefore, they could be incorporated into alternate credit scoring models that show that consumers who consistently make DMP payments represent better credit risks in the future than those who pursue other avenues for retiring their outstanding debt, such as bankruptcy or debt settlement. And of course, if we can achieve that goal, that can be very helpful, especially for those who are enrolled in debt management plans as a part of a long-term goal of achieving home ownership and becoming home ownership ready and being able to qualify for a mortgage and to borrow in the future, which is a goal of many people who enroll in debt management plans. So those are some of the opportunities in addressing that challenge. And if we can go to the next slide, we can talk about another challenge that involves debt settlement transparency, and keeping in mind, of course, that debt settlement is often related to services provided by for-profits that are not part of the NFCC nonprofit network of credit counseling agencies. But nonetheless, people are seeking debt settlement as an alternative or an opportunity to resolve their debt issues. So if we can go to the next slide, we can look at the current challenge and look at some of the opportunities. And there's currently no credit reporting mechanism to show when a consumer has enrolled with a debt settlement company, or if they're making payments to accrue funds for a future settlement. And as many of you know, part of the process that debt settlement companies have in place is that there's a period of time where they're asking people enrolling in a debt settlement program to deposit funds that will accrue so that there can be a lump sum offered at a point when it's time to settle the debt. And of course, that activity of making deposits and accruing funds for a future settlement doesn't show up at all. So there's no way to indicate that a consumer enrolled in those programs is making these deposits in good faith with the expectation of a settlement with their creditor at some point. So the only credit reporting events are ones that show missed payments to creditors during that period of time, and then followed by the eventual settlement. So these actions, of course, result in a dramatically negatively impacted credit score. The lack of a reporting requirement for debt settlement companies contributes to a lack of transparency in the debt settlement space. And with creditors unsure of what happens to their customers who enroll in debt settlement, that's an issue there. So it also makes monitoring and research of the debt settlement space very difficult for regulators and advocacy groups. And as we're conducting research with industry partners like FinReg Lab and others, it certainly is helpful if there's change in this area, because then it can help us draw a more fair and accurate comparison to the outcomes that are achieved with different methods of debt resolution that are available to consumers, and it can help us improve processes on our end as well. So those are some of the priorities and the goals in that area. And if there are any questions about this on the next slide, if you could go to that, yeah, there's information about our website, and I would certainly encourage anyone to reach out to me directly. I'll put my email address in the chat if you have any follow-up questions, and we're certainly willing and happy to answer those as you have them. So now I will throw it over to, I think, Ellie to take it from here.
Thanks so much, Bruce. Yeah, we do have quite a few questions. I'm going to start with questions that came in specifically for Kelly. Okay, for the self-reporting accounts, are they only reported with Experian or with all three repositories? Also, is the self-reporting account actually affect the client's credit score? I think that was for you, Kelly.
Sure. So, so I think that's a question about the customer permissioned data flows, and maybe I can kind of talk about that. And I think there's a couple of other related questions in the chat, so maybe I can knock them all at once. The flows are working different ways right now because there are all these different initiatives. So for instance, as Experian Boost talked about, that's a customer permission flows. It flows into Experian and it affects it when lenders are pulling credit scores, FICO 8 or later, as Rod talked about. Some of the other channels don't go through the credit bureaus at all. So for instance, where the GSEs are incorporating cash flow information, the consumer still needs to authorize that transfer, but it is flowing through the GSE's kind of vendors and their automated underwriting system, and it never touches the kind of traditional credit bureaus at all. There are also some cases where credit bureaus have developed customer permissioned flows, but the data is not going into the main reports. It's kind of being held separately, and it's only happening when the lender, a specific lender, has said, I want this information. When the consumer goes to apply, then they authorize, it flows to that lender, but it's not going to a broader universe of people. So, and in that case, they're getting information, but it's not flowing into a scoring model like FICO 8, for instance, as we were talking about earlier. So that's part of what I was talking about this kind of diversification, because there are all these different ways that the data is flowing. Some of it affects credit scores, some of it doesn't, but is flowing onto the lender for use in other ways. And so it can be tricky to keep track of all this. I think there was a question about some of the other specific initiatives that I mentioned in my slides. We did a report just about a year ago. It was December of 2021 with the Urban Institute talking about utility, telecom, and rental payment history, and kind of cataloging all of these kind of different things. So that's it's a little bit old at this point. There have been some additional developments, but that's a good place to start to get some descriptions, and also links to resources describing some of these different programs and kind of how they're operating. Some of them are initiated by consumers, things like Experian Boost, but some of them are really initiated by the lenders who specifically want the data and then are working with a credit bureau or some other intermediary to get the information into their system. And so the only way the consumer can initiate is to start with that specific lender in that case.
Great, thanks. All right, this next question, there's probably a few of you that could answer this, but it's a little specific, I think, to FICO. So I'm going to ask Elaine to take the first swipe at answering it. So when a client has worked very hard over a long period of time, like years, to keep their credit score in good shape, why, when one late shows up on the credit report or one ding to affect the credit score for all three repositories, the score significantly drops the next month? And this housing counselor has seen drops of 50 to 75 points. Will there be an opportunity to change the scoring model in such a way where the client does not significantly realize a negative impact from just one derogatory event? So I think more than just Elaine can answer, but Elaine, I'm giving you the first swipe at it.
Yeah, no, that's a really good question. And I know that it's so frustrating for consumers when that happens. Paying your bills on time is the largest category of credit data. And it, as the question mentions, it does have the biggest impact if you have a late or missed payment. And the reason for that is just that over the many, many years that FICO has been creating scoring models, we don't just create them out of the air. We really pay a lot of attention to what past data has shown, and past data has shown that when someone misses a payment or they're late on their payment, that they could be a risk, a higher risk. And the more recent the delinquency, the higher the risk in this moment in time. Now, as that delinquency gets older, so say it's been a year since they had a late payment or missed payment, then that delinquency over time has less weight on the FICO score. But the more recent the delinquency, the higher the impact it's going to have on the FICO score.
Thanks, Elaine. Is there anybody else who wants to build on that answer? Okay, so we'll move right along. We have a series of questions that are about Credco, CoreLogic, about the Credit Expert suite of programs. So Tammy and Ken, if I would like you to start out by just kind of talking with our attendees about, if you're a member of NHRC, what the benefit is as far as the cost of single and joint tri-merge soft pull credit reports is. And then also if you could talk about what the cost is for the Credit Expert suite of products.
Sure, thanks, Ellie. If possible, could you go back to the slides that we had for CoreLogic Credco? There's some pricing on there specifically for Credit Expert. But before we talk about the Credit Expert pricing, Ellie, you had asked about the pricing for the actual credit report data. So if you're a member of NHRC, the 3-bureau credit report is a total of $20.81, and that's per applicant. That could change depending upon which client management system that you're using, such as Counselor Max had a third-party fee associated with it. Our office has a third-party fee. So just depending upon which system you're using, but the base price is $20.81. So for Credit Expert, so I did see a bunch of questions in there in regards to the hyperlink not being on their credit report if they currently pull the reports through us. So please reach out to me or my team and we could make sure that's turned on for you. But if you have the hyperlink, that's called Credit Assure. That one is 15 cents per borrower and per bureau. For Credit Expert Wayfinder, that one is $3.90 per borrower per bureau. And the Credit Expert What If Simulator is $4.70 per borrower per bureau.
Great. And I think Ebony might be having some technical issues trying to pull up the slide that you mentioned.
There's no slide with that information on there.
Oh, okay.
Oh, okay. I can get that out to you guys, or we can try and put that in the chat for you guys.
Yeah. If you could do both, Tammy, because we'll send it out with the recording link when we send it out to our listserv. So you can put it in the chat and then you could also send it to us.
Sure, sounds good. And then I also put it out there, if anyone currently does not have access to CoreLogic Credco or currently pulling credit reports with us, there is a contact email and phone number in the slides, but I'll go ahead and put that in the chat as well.
Great, thank you. Somebody asked if Ken could compare his product with FICO scoring system. I'm not sure what the question is asking, because the CoreLogic Credco program uses FICO scores. Is that correct, Tammy and Ken?
So we do use the FICO scores on our credit reports. It is the exact same FICO scoring model that a mortgage lender or broker would pull. So I believe that's, and Ken, I'll need you to correct me if I'm wrong, which I believe is FICO 04, Experian 02, and Beacon 5.0.
Okay.
That's correct.
Go ahead, Ken. Oh, okay. Okay, one of the attendees would like to know if why will paying an account down to 0 lower a credit score? Maybe that's Elaine, that's a good one for you to take.
Yes. So one of the categories of data is length of credit history. And so if you pay an account down to 0, but you keep it open, that's not really an issue, so much as if you leave it at 0 and have no activity on an account for 6 months or more. When you close an account, what that essentially does is it impacts your average length of credit across all of your open accounts. So I hope that answers the question. If there are follow-ups, let me know.
Okay, well, you might as well stay on because this is for you as well.
Sure.
Will the algorithm for the FICO score model or other scoring models be provided to housing counselors as an indication of which items on the credit report show the greatest weight, or how much a particular creditor or account is actually affecting the credit report score?
So I feel that that's where the FICO Score Open Access program comes into place, because when you get your FICO or the consumer's FICO score, you also get up to 5 reason codes. And those reason codes are the items on the credit report that are most negatively impacting the FICO score. And so within the summary report generator tool that I showed, the counselor will put in those first 2 reason codes. And then on the output, it will translate it into the score factors. And then it gives a lot more consumer-friendly information around what the scoring model is seeing in the credit report that is dragging down the FICO score.
Okay. All right. The next question, I think the next question is for Rod, related specifically to your presentation about Experian Boost. What happens if the client pays late? Is this reported to?
It is not. We don't include negative data with the Boost account information. If the account is delinquent, I believe 3 consecutive times, we'll remove that account from the file. So we don't include negative data.
Okay. And then you kind of already answered this in your presentation, but I'll ask it again. If someone already has decent credit, like 640 or higher, would Boost still help?
It can still help, but the higher your scores are, the less effect you're going to see. You know, I've heard from people who say they have like 750 and they'll see, you know, 3 or 4 point increase. So really what happens is the models are going to look at your traditional credit history, and that's going to outweigh the Boost data eventually, which is really the goal.
Okay. All right, this is kind of a broad question for any of you to answer. So with these different products that are offered with the different agencies, are these just for consumers for their own personal use, or do mortgage lenders also see the difference in the same way with a borrower's credit score on their residential mortgage credit report from all 3 repositories?
I can answer that. Or go ahead, Rod.
No, I was going to say I can jump in with Experian with the Boost data, self-reported data that we have. The unique thing is that it is in the report just like any other account. And so if a scoring model incorporates the data, it will be reflected in that credit history and in the scores that a particular lender is using. And I think I mentioned that with mortgage models, some of them are, they currently may reflect adversely. And so we won't feed that data in if it does. So we've looked at the models, but generally, if a model incorporates the data from the Boost system, it's going to help the scores.
Great. And Tammy, were you going to add something?
So, the credit reports that you guys can pull as a nonprofit credit counseling agency will be the exact same data that a real estate mortgage broker would obtain.
Okay. And this goes back to Rod again. Are the credit partners with Experian Boost secure cards?
So with Go, I'll start with Experian Go. You may be offered one of 2 different cards. One is a starter card from a well-known lender, generally higher interest rate. The other is a Petal card, so from a company called Petal, and it's actually interesting because it's a cash flow based decisioning model, but they're a partner with us. So if you're had no history and you're starting with Experian Go, you may qualify for one of those. With Experian Boost, they're not. You may be getting offers from traditional lenders at different rates, different terms. And one of the things we do, if you're enrolled in our monitoring service and our services, is you tell us what you're looking for in a card. It might be no annual fee, low interest rate, whatever it might be, and we'll help match you to the cards from many different credit card providers.
Okay. And then I think this might be for you, Rod. It's either for you or for Bruce. I'm not quite sure. Bruce McCleary. Could we get more information about eCredible, TransUnion, Equifax, Payment Insight, and Perch? First, I've heard of it.
Oh, actually, I think that might have been a reaction to one of my slides because they were listed on those.
Oh, okay.
And that was one of the ones that I was trying to knock out before. As I mentioned, that report from about a year ago describes kind of some of those programs and a bunch of others. So it might be helpful to go and look at those to get more detail on the individual ones. Obviously, the data is about a year old, so there may have been some changes. But as I said a little bit earlier, many of these programs, for instance, the eCredible program is something that the consumer would sign up for, and then it flows on to TransUnion. The Equifax programs that I think were mentioned on that slide are ones that a lender decides they want to use. And then when the consumer applies to that lender, they get an opportunity to permission the data at that point in time, but the consumer can't spontaneously go to Equifax to turn the data on in those cases. So like I said, there are different models in different places, but there are a growing range of different options for consumers who do want to turn on data flows and have them available to lenders or to flow into their credit reports more generally.
Great, thank you. Okay, are there, okay, so I think that this is a very similar question. Are there mirror Experian Boost programs for the other two bureaus, and when? And I think maybe Kelly, that's the kind of thing that you were talking about, yes?
Yeah, and I mean, one of the things that is complicated right now is that these different programs aren't necessarily mirrors of each other. And so when you think about a tri-mergent data coming in from different sources, it may work slightly different ways. And, you know, in some cases, the data is not in the main report, it's kind of a supplemental report. And in that case, it's not probably going to flow into the credit score calculation, but it is available for the lender, the GSEs, you know, the users to use in other ways in their underwriting processes. And so, you know, that's part of this kind of unique stage that we're in, that there's so much diversity in approaches and kind of a lot of things being tested out. One other thing that actually I might say really quickly, I didn't say it before, and I assume it was probably covered in the earlier webinar that was focused really intensely on rental reporting, but I think Rod mentioned this in passing. Some of the older credit scores that are used specifically in the mortgage industry, for instance, the classic FICO that's used by the GSEs when they're pulling for certain scoring purposes, that model doesn't consider rent history, even when it's available to the model. It just doesn't kind of recognize it. The GSEs are in the process of implementing more recent models that will consider rent history when it's available, but it's going to take some time for that to play out. So that's another way in which this is a really complicated time, because where rent history is available, for instance, it may help the consumer get other forms of credit, but it may not have the same effect in the mortgage space because it doesn't necessarily get picked up in the scoring models. It sometimes is used in other ways. The GSEs are using rent history in limited ways to look at some first-time home buyers, but it's not flowing into the credit scores right now. So again, there's just a lot of evolution going on right now to keep track of.
Okay. I'm going to put this question out there. I'm not quite sure if it might make more sense to our panelists than it does to me, but can you demystify the medical payment entries on credit reports from the standpoint of current entries?
I'll take a stab at it. I think it may be in reference to the changes that we're making in the way that we're including medical collection accounts. So if it's related to medical collections, one, we don't include medical collections as an industry until they're now a year old. We'll be removing any medical collections beginning next summer that are less than $500. And scoring systems, as I understand, are also treating medical collections a bit differently. So we hold those medical collections to make sure that they aren't the result of an insurance dispute or a billing error, those sorts of things, to make sure that they're actually a medical debt. So there's some changes happening with the way medical collections come to our files, and also whether or not they're going to appear in the file in the future. And so that's my best guess at what the question's after.
And can you say out loud the answer that you put into the chat about the cost and the Experian
Oh,
boost
sure.
all 3 credit scores?
Yeah, I was watching the chat. Someone said that you could pay, you could subscribe to a service and the boost data would be reported to all 3 bureaus. That's not quite right. You can subscribe to a premium monitoring service at Experian and you can get all 3 reports, so reports from TransUnion, Equifax, and Experian. But there's no service that you can pay for to have the boost information reported. We don't share it. They don't accept it.
Okay. And Melinda, I'll back up because Melinda wanted to say something about medical debt reporting.
Yes, I just wanted to mention that effective July of last year, that any paid medical collections that in the past would stay on 7 years from the date of the derogatory, now once they're paid, they must be removed immediately, and that's effective last summer.
Great, thanks. Okay, so this is Elaine. I think that you can probably best answer this. How is the FICO score affected if a payment is made, but it is only partial?
Actually, I don't know the answer to that question, so I will need to get the answer and get back to you. My understanding is that if it's only partial, so let's say it's an installment loan and your monthly payment is $100 and you only pay $50. Technically, you are not paying on that debt as agreed, but I don't know specifically the impact. If there's coding behind the scenes that the lender has to do, or what that is. So I'll have to get that, and I can share that out with you, unless maybe, Rod might know the answer to that question.
I might add a little bit more depth from the credit reporting standpoint. If you don't pay at least the minimum due, typically the lender is going to report that account as derogatory because you didn't meet the requirements of the payment and of the contract. And as a result, that likely would then be picked up as derogatory in the score. So it would hurt the scores. So can have to pay the minimum due to be considered current.
Okay.
Thank you.
This is a kind of a specific question, so not sure if anybody can answer this directly, but if 5 different lenders pull the credit report of one client within 30 days, how many points will that client lose on their score?
I think that would be for me. It depends on the type of loan the consumer has applied for. So FICO has this deduping logic so that if you are applying for a mortgage or an auto loan or a student loan, the FICO score will look at 45 days worth of data. And if there are multiple requests or multiple applications for one single product type, then it will only count as one hard inquiry on your credit report. And the number of points that it will change, it really depends on so many other factors. We can never really say exactly how many points any activity or event is going to impact in a negative or positive way, because the FICO scoring model is looking at hundreds of different types of data and accounting for all of it. But that deduping logic is really intended to encourage consumers to rate shop for some of those bigger loans, the auto, the mortgage, or the student loan.
Great, thank you. Okay, so for this question, I'm going to answer it, and then I'm going to give Tammy and Ken another opportunity to answer it further. But is Credco considering a reduced fee for housing counseling agencies? So the one thing I want to say, if you haven't already heard this, if you are an NHRC member, a paid member in good standing, you get a pretty decent discount for the tri-merge soft pull reports through CoreLogic Credco. And so Tammy, I'll let you answer that question as well.
Yeah, sure. So we do offer NHRC members special pricing, which is a lot less than what we charge for companies that are not a part of NHRC. It's also a lot lower than our mortgage brokers and mortgage lenders pay on their hard inquiry credit reports. And just as a recap, 3-bureau individual report is $20.81, so $20.81, and a joint is $41.62.
Okay, great. Okay, let's see. Just a comment that somebody said that you answered the question about paying things down to zero. She said the slide from Ken with the recommendation from Credit Expert said not to pay it to zero. We usually reject that and advise folks to pay balances in full, but use the card every 4 months or so to keep active and be reported as paying as agreed. We do not recommend closing existing accounts. Just to follow up. Does anybody have updates regarding medical collections no longer being allowed to the report on the credit bureaus? And we had that question got answered by Melinda. Thank you. And I see that Melinda put something into the chat, a link to an article about it, if people want to access this. Can we do a soft poll and get FICO scores? Yeah, the soft poll with Credco is FICO scores. I think, again, we answered that question. Somebody's just wondering if a credit card interest rate can be negotiated. Anybody have thought about that? Well, I will say everything is negotiable, especially when it comes to a credit card rate. Consumers should be comparing different credit cards and what their offers are. And, you know, if you have a current credit card and you find an opportunity for a lower score or a lower interest rate with a different credit card, you can go to that credit card. You could let your credit card company know that you're about to move and they might offer you something better. But yes, everything is negotiable. Okay. What if you settle an account? What is the effect on your credit?
I'll take a stab. The account status would be reported as settled, paid for less than agreed, and that's going to hurt your scores. It's considered negative.
Well, and I'll jump in and to add to that a little bit. When you settle your account, not only does it show settled for less than the full balance, but there's also the element of tax liability for amounts that are settled. And I believe the threshold, Rod, is well, anyone can chime in here, but I think it's $600. But anything exceeding $600, there's going to be a tax liability on the amount settled above that amount that's going to fall on the consumer.
Yeah, and I'd add too that Bruce, that's a good point. And if the individual, if the remaining debt is forgiven, you may receive a 1099 form and owe taxes as if it's income. So.
Okay. Let's see. A lot of medical collection don't share the name of the creditor on the credit report. So the client must call credit bureau to find out the creditor. If they can't provide the name, then the credit bureau must remove. Is this correct? And I'm assuming they being the credit bureau, if the credit bureau can't provide the name. Kelly, is this something that you know about? Or Rod, if you have the answer, go for it.
If the creditor doesn't provide the name, I'm trying to understand. In order to report to us, we would need to have, the creditor would have to meet our reporting requirements. One of those things is going to be the identity of the reporting entity. I'm not sure what the question is there.
This is just a guess. I'm not a deep expert on medical reporting, but there are some limitations on medical debts that are designed to protect privacy. So I wonder if what's happening is that on the report, certain information might be withheld from the report, but it doesn't mean that the credit bureau doesn't have it. It just means it's not being listed because maybe the provider name would reveal the nature of the medical condition, and there's protections against that, if that makes sense. So if you call, I think the credit bureau would still be able to answer the question.
Maybe.
Does that make sense to you, Rod? I don't know.
Yeah,
just-
that's your so we do not include medical information, including the name of the medical collection agency on the lender's version of the report, or in this case, the service provider, because it would violate HIPAA for exactly the reason Kelly mentioned. So on the consumer's version, if they get their own report, annualcreditreport.com or monitoring service, we will list the name of the medical collector or provider, who are healthcare provider, hospital, along with contact information. But we do not show that on the lender's version of the report.
Okay.
The collection agency, if a collection agency is trying to collect the debt, can that show up on the credit report? And is that maybe what we're talking about here?
If it's a medical collection agency and tied to a specific medical issue, no. If it's a collection agency for a standard, any other kind of debt, yes, it would show the name of the collection agency.
Right. So you have a collection agency, but then the real issue is what is the debt that collection agency is collecting on? So that might be what the question is.
Well, in that case, we would show medical collection. So you would know that it's a medical collection specifically on
Or
the
not medical, if they're collecting, a car loan or whatever. I think that's the question that they're asking is if they're not able to tell you what the amount was, what the source of it was, the original source.
Okay.
That I'm not sure. This is specific to this. The question I see is specific to medical collections.
Yes, it is very specific to medical questions, medical collections. Yes. Okay. All right. So just kind of a question to throw out there. It's not really a fully answerable question. It's kind of a thought. What do you think? So if bank account cash flow scoring is a direction we are headed, how will counselors help clients with this model, as opposed to FICO, where we can say, pay the bill on time, keep your utilization low, etc.?
I could probably start with that. So that is one of the challenges to this kind of rapidly evolving state, is that different lenders and different scoring systems are using bank account different data in different ways. So whether there's a scoring system, there's potentially kind of reasons being generated and kind of transparency that way. But in some cases, what lenders are doing with this is distilling kind of payment history, but like we talked about, it might be payment history for rent, for utilities, for telecom bills, as compared to kind of credit products that are flowing through to traditional credit reports. So the basic concept of pay your bills on time still holds for that. In some other cases, they may be looking more at kind of the steadiness of the consumer's income and kind of does the account go negative sometimes, if the consumer's overdrawing the account. So again, it's a similar concept in terms of kind of managing your finances and making sure you're not overdrawing your account and paying things on times. But it does vary depending on the lender. People are still analyzing this data to understand what's most predictive about it and how to use it. And that will also flow through to kind of what adverse action notices are generated and kind of how we can educate consumers to, how they balance their budgets. But I think a lot of the basic principles are similar in terms of, lenders are looking for evidence that consumers are managing their finances well. They're paying things regularly and on time, and making sure that they're, not running late and not overdrawing accounts and things like that as a starting point. But I do think it's an area where things are going to continue to evolve as we see how different people use this data and how they what turns out to be most predictive and most useful in helping underwrite consumers.
Great. I do want to let everybody know that Rod Griffin did need to drop. So we're going to try to get through the last bits of the questions in the 15 minutes that we have left. How long do settlement payments remain on the credit report? Elaine, is that something that you can respond to?
Settlements, I'm not as familiar with. I'm a FICO score open access expert, not necessarily a FICO scoring model expert. So maybe
Gotcha.
One of the folks from CoreLogic or Experian might be able to speak to how long something will stay on a credit report.
Well, I'd like to jump in there because there are a number of questions related to settlement that sort of tie into this. So I think we can maybe address each of these individual questions. There was also a question about just the negative impacts of settlement and what that means for an individual who might be considering or going through that process. Let me tackle that one first, then we can talk about how long the information stays. But one of the things about debt settlement that was addressed earlier is the fact that the accounts that are listed on a credit report as being enrolled in debt settlement, obviously they would show as settled for less than the full balance. But it is the process by which someone goes about settling the debt that may be even more consequential with regard to their credit score. And the one thing that I want to call attention to, which ties into something that I mentioned in my presentation, is the practice of stopping regular monthly payments to a creditor while putting money into an account that would ultimately be used as an offer for a lump sum or partial lump sum settlement. Some, and I'm not saying all debt settlement companies do this, but some for-profit third-party debt settlement companies have been known to advise their clients, their customers, to stop paying the creditors while they put money into this account to be used later as a good faith down payment or as a full lump sum for settling for less than the full balance. So that practice by itself does considerable damage to somebody's credit score, and that would be a byproduct of going into to debt settlement. That doesn't mean that somebody can't continue making monthly payments to their creditors while putting money into this fund, but I'm just saying that some debt settlement companies have delivered this very bad advice to their customers, and as a result, there's been some damage related to the debt settlement. I would just go back to the credit reporting rule when talking about how long these debt settlement items stay on a person's credit. It goes back to how long, I think it ties to how long negative information stays on your credit report, negative activity reports for 7 years from the date of last activity. So, you know, I would go by that rule of thumb in terms of how long this debt settlement activity would stay on a person's credit report.
Great. So I do want to say one person mentioned that if a consumer obtains their free credit report, the actual medical debt would show who it's coming from. It wouldn't say unknown. It would show who it's coming from. Melinda, did you want to say something?
Yes, this is such an important topic that you were discussing. So I wanted just to mention something about zombie debt. And zombie debt is a name that the Federal Trade Commission came to what at credit.org we call junk debt buyers. So you'll have sometimes a business model out there where a collection or, so to speak, creditor will buy old derogatory debt for cents on the dollar, and they'll place it on the consumer's credit report as though it's brand new. So the original debt may have since aged off, kind of by what Bruce was describing as, you know, it annotates the report by more than 7 years from the date of the original derogatory. So I just want to mention that sometimes we've had our clients indicate, you know what, just to kind of buy myself some peace, I may be willing to make some type of settlement arrangement on that. But we always caution them to get the debt validated and verified before they pay one of these junk debt buyers. At the Federal Trade Commission website, you'll see it's their top complaint there, this model I'm speaking of, and the Federal Trade Commission is the one who dubbed it zombie debt. So just kind of wanted to footnote that in there with this kind of hot topic. Thanks.
Great, thanks, Melinda. All right, I think I'm going to just ask this one last question. Will looking for an apartment where the landlord pulls your credit report hit your score?
So that would be a question for FICO, I'm assuming. If they are doing a hard inquiry, then it can show up as a hard inquiry, and a hard inquiry will negatively impact your FICO score. The FICO scoring model only looks at hard inquiries within a 1-year time period. The number of points, as I mentioned earlier, we just have, there's no rule of thumb as to how many points any one activity, good or bad, will impact the score. So it's, I'm sorry that I can't actually give a number, but if it's a hard inquiry that they are doing, then yes, it will impact the score for up to a year.
And Tammy or Ken, does Credco offer soft pulls for private individuals like that?
We don't work directly with consumers, so the credit reports that your members pull will be soft with all 3 bureaus.
And so that any like a property manager wouldn't be able to pull through Credco?
No, we'd have to refer them to a company that does offer those types of credit reports.
Okay. And I believe that I've gotten to all of the questions. If I missed anybody's questions, I'm so sorry. I tried really hard to get to everybody's questions. But we are at 2:52. And so with that, I'm going to hand it over to Bruce to wrap it up.
Well, thank you, everybody, for a terrific session. Very, very helpful. We appreciate this, and we will probably revisit this issue soon. You certainly heard about the advantage of becoming a member because of the CoreLogic Credco discount. I know that credit reporting costs have gone up dramatically, and we appreciate that CoreLogic Credco has been as supportive as they have been about all of your work, and so encourage you to join up. There's a link on that that we can put out through the chat if you, or you could easily go to our website to become a member. We also have a discount for Savvy, the online student loan service program. A good part of it is free, but certainly the year-round service, which can be quite helpful for people, is also quite useful. And you can use it. You could use it for clients. You could also use it for staff for sure. And it's particularly helpful since you're a nonprofit and there's a more aggressive public student loan forgiveness program, and they can be quite helpful in that. We also do let people know about unusual funding opportunities that you might not have heard about through our program, and your office will get emails about that as a member. The real reason to join is really to support our work in advocacy, whether it's in Congress, whether it's with the administration, whether it's with the industry, or whether it's things like our webinars here. And a good part of our budget is covered by membership dues, so we really count on you, as I think everybody can understand. So the other big thing is that we will have our national conference coming up in the end of March, the 27th and 28th. We'll have a little special breakout for members, and the pricing will be substantially lower for members. But we really appreciate that a lot of you feel like NHRC is worth supporting, and you're doing that, and that means a lot to us. On that quick note, we're going to just move forward. I just want to remind people that there's a very interesting, valuable session coming up on, I believe it's the 26th, the last one of the month for us. And it's on domestic violence. And to be quite frank, this is a real problem in our communities and among your client base and in society today. It turns out that there are counseling agencies who are doing very important, very valuable work in this field, and that housing counselors could potentially fit in as not social workers, but in dealing with, there's lots of financial and housing issues tied in with domestic violence. So this will be a real educational webinar. It will, I felt like just in the kind of prepping for these meetings, I have learned a lot, and I think you'll learn a lot from it. CCCS MD, Helene Renaud, and her team are going to present what they're doing. They'll have some resources. They have a pretty exciting, valuable program that they're doing in Maryland. It's a program that we think could be replicated in other locations. And in the same way that we want to kind of elevate important issues in our work, that we might be able to broaden our impact and value. This is another one of those places where we think that there's real opportunity. So we're hoping, it would be worth your while to join us for that session. So with that quick note, thanks everybody for coming. It was a robust session, and we really appreciate that so many of you taking your time, and we will talk to you soon.